Hi guys, welcome to my YouTube channel. Today we are gonna discuss and analyze about the current ratio and what are the impacts of current ratio. So let's begin. Current ratio is determined by dividing current assets by current liability. It measures whether the firm has sufficient liquidity to cover short-term obligation of the entity. Yeah. Let's assume that for instance, let's assume that current ratio is 0.6596 times. Okay, it means that current ratio is 65.96 percentage of current liabilities, right? Uh, we can say just by seeing the current ratio that entities will have difficult time paying off the debts as liquidity as here liquidity is low. So current ratio includes cash equivalent, trade receivables, bank inventories, right? And trade payables include short-term liabilities. Current liability includes trade payables, short-term liabilities, bank overdrafts, overdrafts, right? So, um, so the question arises that I'm sorry. What does what does that mean? Current ratio is low. It means that cash or bank is low, trade receivable is no low, or inventory is low. Surfacely view on surface view, it means that entity is better at collection of receivables, making investment decisions of cash or bank balance, but is not good at paying its debt, and neither it is good at paying its suppliers. On surface view, we can uh, understand that, and let's talk about what are the consequences of low credit ratio. Okay, low. The consequences are it will have bad relation. The entity will have bad relation with lenders. Um, it will create obstruction in future short-term lendings. Due to this, the entity may lose good suppliers, may lose good deals, which lead to decrement in net profit due to increment in high cost of materials and labors. Entity may lose credibility and trust, due to which entity may have bad reputation too. Okay. So, what's the question arise is a higher credit ratio better? It depends, right? It depends on how much the credit ratio is. Higher credit ratio may mean that it is high cash. Mean that the entity has high cash and cash equivalent, trade receivables, inventories, right? And high cash in entity means may also mean that it cannot manage its cash balance, does not have policy to manage cash balance. It could arise due to misuses by authority. It could arise the issue of cash misuses by the authority in the entity, right? And high trade receivables may also mean that it is bad at collection. This increases chances of bad debts, loss of opportunity cost, and high trade receivable high in high inventory there is moving inventory, non-moving inventory, and obsolete moving inventory, right? Like we have already paid to the creditors, but what we have already paid to the creditors while buying the inventory, right? The So our money is hold on that inventory. Money has been hold on that inventory, but a non-moving, it is not selling. It is not. It is not. Yeah, it is not selling. It is not going out. And obsolete. Obviously, it is damaged, so we cannot sell it. We have to have a proper control for all of those uh, current assets. It may also indicate that it is good at paying expenses. High credit ratio may also indicate that it is good at paying expenses. How so? Like how we can say how, but if trade payables, trade receivables are low, then we can say that entity is good at paying expenses, right? Okay. So high credit ratio may present that it have entity have enough cash to pay off, but pay off its debts, its short-term liabilities, and fulfill the liquidity need of the entity. But on detail, they may not be able to pay it off with current cash in hand. So we have to so manage like so on analyzing part we have to analyze the actual situations. The actual situation may be different than what the ratio shows to. We have to keep in mind while analyzing the current ratio part. Okay. On that scenario, current liquid ratio is also best option to know about the current cash in hands, the status of cash in hands of the entity. Okay. And while calculating current ratio, like current asset, those cash should be included in current asset, which usage is not restricted. Which usage is not restricted from the entity. Okay, if the cash usage of the entity is restricted by the entity, then only the cash and cash equivalent amount that the entity use freely should be included in current asset for ascertaining better liquidity status of the equity. So credit ratio may look small but is a big tool for decision making because it gives us the overview of our working capital. High credit ratio mm, high credit ratio alert long term and short term issues. Long term and short term issues, and it's a long term and short term chances of having an issue, and low credit ratio also may show the long term and short term effect that will happen to the entity. Okay. So for having a proper current ratio, there is a need of control regarding receivables, payables, inventories, cash balance. Okay. So in case of inventory, moving and non-moving item must be categorized properly. Categorization also help. Non-moving and non-moving items should be categorized and properly, and should be analyzed whether that it has gone obsolete or not. The categorization help big size company to make decision regarding production, purchase of inventory, and saving its cost. It helps making decision what not to buy, for how long it should be hold, and for on what quantity it should buy at a time. It helps in this decision making. The entity should transfer the obsolete item to profit or loss. If obsolete item are not transferred to statement of profit or loss, it overvalue the profit of the company, misleading the decision maker. And there should be a system of proper collection. The receivables should be collected on a timely manner. It helps in increasing cash and bank balance, but it makes the current ratio same as before. Aging reports, and in case of receivables, aging reports also should be made and made regularly. It helps in eradicating any chances of bad debts and eradicating and identifying the chances of bad debt and risks associated with it too. And there should be timely collection of payments. And aging report should be made for the same too. Okay. So hence we can say that for correct current ratio, correct categorization is also important. Payment due within the period of 12 months should be categorized as current liabilities, and long-term loans which due period is within the 12 months should also be reclassified to current liability, and similar treatment should be made to the long-term investment too. If its due date is within 1 year, then it should be classified as current asset.